Can you beat the investing strategy of Harvard? This is Bill Scheid from Applied Finance Research, and that's the question we're going to answer in this video. So first of all, let's talk about the Ivy portfolio. The Ivy portfolio originates from the investing strategies of the Harvard and Yale endowments. And in this table, we have the weight percent and the investment theme of each of the holdings of the portfolio. So we can see that we have 20% weightings for total stock market, international stocks, intermediate bonds, commodities, and real estate investment trusts. Now, what kind of return can we get from the Ivy portfolio? This is a buy and hold backtest generated on etfreplay.com from the end of 2007 through March of 2024. On the left, the green line is the Ivy portfolio buy and hold return, and the blue line is the S&P 500. The chart on the right summarizes the results. So in the yellow column, we have the S&P buy and hold results, and in this pink shaded column, we have the Ivy portfolio buy and hold results. In sum, we can see that the Ivy portfolio doesn't keep up with the S&P buy and hold in terms of total return or compounded annual growth rate, but it does have a slightly smaller maximum drawdown. So the question is, can we beat the Ivy portfolio buy and hold? And we're going to answer that question by applying two different monthly asset allocation systems to the Ivy portfolio. The first strategy we're going to apply to the Ivy portfolio is a portfolio moving average system. So this is a disciplined, rules-based strategy that rebalances once per month. And the strategy evaluates the suitability of each portfolio constituent using moving averages. Now, as you probably know, moving averages are a very common indicator used in technical analysis, especially the 50 and the 200-day moving averages. Those are widely used and very popular. They're considered to be important trading signals. And of course, moving averages have been tested in the scholarly market literature and are academically rigorous concepts. If you want to review some of that research, here are a few of the authors. So let's see what kind of results we can get if we apply portfolio moving average strategy to the Ivy portfolio. So again, on the left, the green line in the chart is the Ivy portfolio with the portfolio moving average system rules, PMA system rules applied, and the blue line is the S&P. The chart on the right again summarizes the results, and now we've added the Ivy with the PMA system here on the right. What we can see is that we've increased the total return from 119.6 to 141.1. And at the same time, we've greatly reduced the maximum drawdown from minus 44.7% to minus 11%. That's a huge drop. And we can see where that is reflected in the return to drawdown ratio. I really like that metric because for me, it's a shorthand way to get a sense of the value of applying the system rules. But why should I apply any rules when I could just buy and hold the S&P or the Ivy portfolio? I mean, that's a legitimate question. You could actually do that. Well, return to drawdown ratio, for me, is a good answer to that question. That shows the bottom line value of the system. It's basically what kind of return are we going to get for what kind of risk? And of course, that's what everyone wants in investing. Everyone wants to maximize the return and minimize the risk. So here we see that with a return to drawdown ratio of 12.8, that's almost 6 times better than with just the regular buy and hold. Now, what if we said to ourselves, in terms of a next question, what if we said, well, we'd like to boost the return and get a bit closer to the S&P 500, and we're willing to accept a bit more risk. 11% for maximum drawdown is amazingly low, and we'd be okay with going a little higher on our maximum drawdown if we could also get a higher return. So that's the hypothesis for our next question. And what we're going to do next is apply a momentum system to the IV portfolio to see if we can answer those questions. Similar to the PMA strategy, this is a disciplined rules-based strategy that also rebalances once per month. And now it's going to evaluate the suitability of each portfolio component using momentum. What is momentum? Well, the oversimplified definition is that momentum is the capacity for a price trend to continue. This is basically analogous to Newton's first law of motion, which states that objects in motion tend to stay in motion. The idea here is markets in motion tend to stay in motion, and this connects to the market belief that the trend is your friend. Momentum has also been tested in the scholarly literature and published for decades. It's quite academically rigorous, and here are some of the authors who have published some outstanding works on momentum. Now, let's take a look at the results that we get if we apply a momentum system on the IV portfolio. Again, on the left here, the green line is the IV portfolio, now with the momentum system rules applied, and the blue line is the S&P. And now we can see that the system equity curve has beaten the S&P in terms of our ending total return. The chart on the right summarizes the results, and now we've added one more column for the IV system with the momentum strategy rules. And what we can see is that we've increased the total return. So now we've beaten both the IV buy and hold and the S&P in terms of total return. And at the same time, we've got a maximum drawdown that's a good bit lower than both of those. Our CAGR comes in at 11.3%, and our return to drawdown ratio has jumped to 14.9, so roughly double that of the S&P at 7.2, and more than 5.5 times that of the IV buy and hold. And look at the difference that this makes in our ending balance. Here's something very interesting. Notice that the difference in the compounded annual growth rate between IV with momentum and the S&P buy and hold is only 1.1%. 11.3 minus 10.2, 1.1%. But compounded over 20 years, this ending balance basically is a hypothetical $100,000 account growing for 20 years at the compounded annual growth rate. So 1.1% compounded over 20 years, it makes the difference of more than $150,000, almost $150,000 here. And when we compare the ending balance of IV with momentum to IV without momentum, the difference is almost 600,000. So can you beat Harvard? The answer is yes, and you can do it with some very simple monthly asset allocation strategies that are based on academically proven concepts and only take minutes per month to execute. This is Bill Scheid from Applied Finance Research. Thanks for watching, and happy investing.